Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 242nd podcast VideoCast for the week ending June 6th, 2024. Some family stuff. We'll get right down to it. First and foremost, want to congratulate Mimi, our oldest daughter, for getting Best Committee Delegate for Model UN. Very proud of you. Exciting stuff. Then they had a meet this weekend. You can see Annabelle and Mimi there. Exciting weekend. They crushed their swim meet. 9-year-old Annabelle is turning into a distance freestyle sprinter. Annabelle won the 12 and under 200-meter free, landing her in the top time in the nation for 9-year-olds by 3 seconds. Our distance freestyles queen, 11-year-old Mimi, crushed the 400 free, and she is now number one in Connecticut for 11 to 12-year-olds by 5 seconds. Mimi is also turning into a sprinter. She won the 12 and under 100-meter freestyle by 2 seconds. It's fun seeing them excel in new events. So great hard work is paying off. Congratulations. I know I put these pictures in front of the News Corp building every week, but a lot of new people are joining. So for those of you who've seen it before, hang in there. That was today. I got called in to do Cavuto coast to coast. Very exciting. That's the Cavuto studio on the 3rd floor. You can't take pictures inside, but you can get a little look back there, and a lot of fun. Want to thank, as we move here into media, Neil Cavuto, Jenna D. Tomasis, and the whole crew there for having me on today. We're going to listen in now, some important stuff about Nvidia, the Fed, and more. Here we go.
Kelly, much appreciated. Kelly O'Grady following that, as is my next guest following all of this. Thomas Hayes, the Great Hill Capital, LLC chairman and managing member, real schmatty pants when it comes to this stuff. So Nvidia, I think, splits tomorrow, yes. Right? Formally 10 for 1. That usually, ignites retail interest, even though it doesn't make a difference in it. But I get it. What do you think?
I think trees don't grow to the sky, Neil. If you look at the total capital markets in the United States, it's $110 trillion. That's all U.S. equities, all U.S. debt.
Wow.
This is a $3 trillion company. So that means if you make $100,000 a year, are you indirectly or directly spending $3,000? Is every single person? So yes, it could go up from here. It usually does after splits, but I might fade that. As a matter of fact, Jensen Huang filed to sell 735 this morning.
He's the head. He's the
head. And you have the DOJ sniffing around. So
so this could have also been used as an excuse to sell. Now, of course, he has, $18 billion worth of shares?
Yeah, no, this is a standard 10 plan filing. The bull case is it's trading at 45 times earnings, but it's growing earnings at 30%. It's got 70% margins, Neil. Your margin is my opportunity. I don't think all these companies are going to sit back and just let them take all the share. I think you're going to see some competition, believe it or not, from Intel, maybe AMD.
Is it a rich stock now? I know people look at, forward earnings and say, by that definition, it's a little toppy, but it's hardly nosebleedy. The earnings seem to justify it. The momentum seems to justify it. Where are you on that?
Correct. If the estimates are correct, it's not overvalued in the sense that if it can grow 30-40% a year and trade at a 45 times multiple, that's fine. I think what's questionable is whether that 5-year growth rate of 40+% is going to be the case, because I do think the DOJ is going to slow them down. And I do think competition is going to come up, and I think that's underestimated in the market.
Why, by the way, and Kelly touched on it, but maybe you can help me with this. Why now, Thomas, with this DOJ move?
I think they saw what happened with Apple's walled garden, and they got to it too late. And by the time they got to it, they couldn't do anything about it effectively. And I think the bulls talk about Nvidia ecosystem, where the developers develop on their software platform. And I think the DOJ wants to make sure that they don't run into another situation where it's a walled garden, no one else can get in, and that leaves all the other competition and pricing power in the dust.
What about the NASDAQ itself? Nvidia, of course, is a big driving force. It's not exclusively so. The Magnificent Seven and all of them, they disproportionately weight things, but not as disproportionately as they once did. I'm just wondering your thoughts on that, the Federal Reserve and interest rates and Europe cutting rates and maybe a sign of things to come here.
Yeah.
Play that all out.
Neil, this is a sea change. We're starting a global coordinated central bank easing policy. You saw Switzerland, you saw Sweden, you saw Canada, you saw the ECB, and believe it or not, we're next. So we're going to get...
You really think so?
Yeah, we're going to get the one or two.
Next?
Probably September for sure, and maybe September, December if we get 2 cuts. you're starting to see the cracks that they wanted to see in the labor market. A little weak on the ADP, a little strong on the continuing claims. Same thing with the ADP. We'll see tomorrow is a big day, and then we have the inflation numbers next week. But European PPI, producer prices, were actually negative this week. So wow. I do think
you would argue they're justified doing what they're doing.
Yeah.
Right? I mean, would we be justified doing it now? In other words, there's been such built up expectations for a rate cut that might we sell off on a rate cut?
I think that's a possibility. Buy the rumor, sell the news.
Right.
But you have to keep in mind all the companies that have to refinance debt, particularly among the small cap companies, they're going to hit that window, and the market's actually going to view that positively. If you look at small caps have been lagging for a time because of their balance sheets.
Right.
Once we get a cut or two, refinancing window opens, and that could be a chance for the catch-up trade, small caps, mid caps.
Back to technology, the overarching theme so far, it's been a good half year or so, close to it for the markets. Everyone didn't go away in May. They're still sticking around, it would seem.
Yeah.
Play that out.
Well, since 1928, in the fourth year of an election cycle, which we're in right now, June through August are the strongest 3 months of the year, with average gains of 7.3% for the indices. So wow. We're in the sweet spot. We may, in fact, get that summer rally before a little more choppiness before the election in the fall.
And when does the election begin to weigh on the markets?
Probably after August. September, October is where we could see a little more volatility after some strength this summer.
Fascinating. Thomas, thank you very much. Thomas Hayes following all of that. All right, Steve Moore, I think we got everything plugged in. He's back with us right now, the former.
And we're back. And then I also had the pleasure to join Bloomberg Radio Daybreak Asia last Thursday. Want to thank Bonnie Au, Juan Torres, Brian Curtis, and Paul Allen for having me on. We're going to listen in now.
Joining us now live on the program is Thomas J. Hayes, Chairman and Managing Member of Great Hill Capital. Thomas, thank you very much for joining us on the program. So we've had a little bit of a choppy period here, but on balance, it's been a pretty good year for equities. Bloomberg Intelligence says that S&P 500 companies' average net income margins are projected to surpass 13% in the second half, and that they would rise even more next year. How do you like the current environment for risk assets?
We're pretty sanguine, and thanks for having me on the show. I mean, you just saw the earnings season, 78% of companies reported a bottom line surprise, 61% top line surprise, and earnings came in at plus 6% when everyone thought they would come in at 3.2. So we like that. What's the complaint that we hear, Brian and Paul? Well, we hear that multiples are too high. And to that, I ask, compared to what? Because if you look from 2000 to 2024, you basically had 6.38% compounded annual growth rate. And the last 10 years, you had a 17.6 times multiple, average PE multiple. Well, now for 2024, we're looking at 11.4% earnings growth, and next year, 14.2% earnings growth. So more than double the last 24-year average, and the multiple's just a tick above. So if you look at PEG ratios, we could potentially have a little more multiple expansion.
And where do you go hunting if you're looking for dividend stocks?
Well, you know, I think that's going to be the big surprise of the back half of the year, Brian and Paul, in that managers are 51% underweight. And if short rates have peaked, which we believe that's the case, and we're going to see a dot plot in a few weeks, we think the pendulum has swung too much from expecting 7 cuts at the beginning of the year to really not expecting much. And we think the truth is somewhere in between. I do think we'll wind up with 1 or 2 cuts before the end of the year, which means short rates have peaked, which also means there's going to be a demand for higher dividend yield. 8,500 stocks offer higher dividend yield over the next 3 years than cash. And then you've got capital appreciation as gravy. So we've got 2 picks in that domain. We like Crown Castle International. This one's down almost 50% off of its 2021 highs. They've got 40,000 cell towers around the country and a brand new CEO, Stephen Moskowitz, as a catalyst.
I'm curious about your thoughts on, second and third derivative plays on the big chip makers. I mean, Nvidia gets most of the credit, but others like Broadcom and AMD have done okay, although I have to say AMD has corrected quite a bit in the past couple of months. But what sort of dividend plays do you like?
Well, I'll tell you, if you want a derivative play on chips, which is a derivative play on AI, here's one that you're not going to hear from any of your other guests. How about a natural gas stock called Comstock Resources that Jerry Jones owns about 65% of the company? I think the demand for energy, we've seen utilities already take off on that premise, which certainly have the dividend yields, but we haven't yet seen the natural gas stocks take off on that premise. And I think they're going to be strong source of demand for energy. The average AI inquiry requires 17 times the energy of a Google search. So I think natural gas is a second and third derivative play on chips and AI demand moving forward.
In this conversation, I'm just getting the sense that Fed policy is taking a little bit of a backseat in your decision-making process. Have you become accustomed to the notion of higher for longer, or perhaps even higher indefinitely?
Well, we're kind of more in the dovish camp. We're expecting 1 to 2. I think at this point, a lot of managers have given up on any cuts. We also look at, if you look back to 1928, the fourth year of a presidential cycle, on average, June through August happens to be the strongest 3 months of the year, with average returns of 7.3% over those 3-month period. Since 1928, and a positivity ratio of 75% of the time it's positive. So I think there are a lot of tailwinds. I think the multiple is reasonable relative to earnings growth. Estimates continue to climb the wall of worry. Even GDP now, we saw weaker Q1 GDP this morning, but GDP now for Q2 from the Atlanta Fed is at around 3.5%. So there are a lot of positive and disinflationary trends you're seeing with a lot of the restaurants and some of the stores, et cetera, that we remain constructive for sure.
Sure. One of the reasons I asked you about those second and third derivatives on AI is that we're seeing more and more restrictions now on these companies. One of the top stories today is it's a Bloomberg-sourced story that the U.S. is putting some constraints on the chip makers for business in the Middle East. So you're cutting off China, you're cutting off the Middle East. Do you worry about that at all, that geopolitics comes in?
Well, I worry about it if you're a U.S. chip maker, because what you're effectively doing is forcing your competition to develop it internally. And you just saw China raise that $48 billion fund to catch up on chips, and you're seeing some breakthroughs in China chips. So I think the unintended consequences of all these unnatural sanctions are going to come home to roost over time. In the short term, it looks like a winning strategy, but in the long term, I'd be a little cautious. We do know the chip business is historically cyclical.
Absolutely. Thomas, thanks so much for joining us. Thomas Hayes, Chairman and Managing Member, Great Hill Capital.
And we're back. And the reason that's key to get those out of the way in the beginning is because in a 5-minute or 4-minute segment, I'm talking about everything I'm thinking about for that entire week in 5 minutes, and it saves us a lot of time. So you get the broad overview, the broad thinking, and then we can drill down to specifics. Want to thank Chibuke Ogu for including me in his article on Reuters today, and then Luca Blauman and Lilinda Vita for including me in their article on StoxPo last week. I believe StoxPo is started by some people that rolled out of Benzinga, so happy to do that. And then finally, if you haven't gotten your tickets for the Accredited Investor Virtual Money Show next Thursday, by the way, I will be in Atlanta next week from Wednesday through Saturday with a little bit of free time. So if either A, anyone can get me on Peachtree on Friday, or B, potential or existing clients that want to meet for lunch or coffee, do reach out at the website hedgefundtips.com. Click on contact. You can get me there. While you're there, ladies and gentlemen, click on terms. This is opinion, not advice. You want to talk to your financial advisor before you do anything. We specialize exclusively with accredited investors and qualified institutions, more sophisticated investors. Now, you can get your free ticket to the Money Show by just registering here. If you go to Hedge Fund Tips, you'll see it towards the top, and then click on the register here, and those tickets are free. Quote of the week, we've got a couple. First from Charlie Munger, the big money is not in the buying and selling, but in the waiting. That is key, and that's compounded by Seth Klarman. And we've mentioned this one a few times in the past. I couldn't agree more. It turns out that value investing is something that is in your blood. There are people who just don't have the patience and discipline to do it, and there are people who do. So it leads me to think it's genetic. And the older I get, the more I agree with that assertion. There's no question about it. It's you're either kind of born with that ice in the veins temperament, or you're not. But for those of you who are, you probably filtered yourself out, and that's why your clients and or you're listening to this podcast and honing your skills in even more. Bank of America, thanks to my friends over there, you know who you are. We've touched on this many times. The rail freight volume continues to look better and better, which is going to help bring manufacturing out of a recession. Korea exports also continue to flourish, which is a positive thing. And then finally, this inventory cycle that has been the premise of so many of our positions is rocking and rolling. We've already seen it in Generac up from 90 and high 80s to it got up to 150. It's around 140. I think that one's just getting going. We'll see the same with Stanley Black & Decker soon, and a few of the others that have gone from destocking, selling off inventories, fire sailing, because they over inventoried during COVID out of fear they wouldn't get enough supplies. And now restocking cycle is the beginning of cycles, ladies and gentlemen. Restocking is the beginning of cycles, not the end of the cycle. So for all the pessimistic people or worried, nervous Nellies out there, look at here, 2001, 2009, 2020, and here we are one more time. And you don't get many of those opportunities in life. And we've had so many of you come on in the last 2 years and load up on the right companies. Yes, we've had the Amazons already almost double. And Google's go really, really fast. But the core of what we want to do has just started beginning, and we're excited about it. By the way, a few of you reached out in the last 2 weeks, had great conversations. As I said, we're closed to the smaller accounts until we're going to open up sometime in Q3, which is actually just a few weeks away at this point. But it was smart of them to get ahead of the curve because they can start getting their paperwork in order. And when we finally open, they'll be first in the queue and ready to go. So that's good. And for the $5 and $10 million accounts, we're always available, bespoke service for the high level accounts. Okay, so that's that. But then the mid caps we talked about on Cavuto, small and mid caps, those started to bid. They leveled off, and they're just beginning their phase. So when you think about mid caps, quite a number of them. VF Corp is a good example. Small caps. Cooper Standard is a good example. Comstock Resources is a good example. So we position ourselves to take advantage. And then the dividend players, which we've been talking about in recent weeks, which we touched on Bloomberg Radio, CCI, which we're going to talk about, and Baxter and a number of others. So sector, these are ratio charts that we want to take a look at. A few of them here. Biotech had been out of favor. It's now actually starting to make a move. If you look at, let me just pull it up because we haven't talked enough about this, and we still have our exposure. We're just patient, sitting there, like Charlie Munger said. The big money is not in the buying and the selling. The big money is in the waiting. Well, if you look at XBI here, you buy in the hole in spring of 2022, rallies up. It's like, all right, we're going. Then it retests it last fall, and now it's starting its final phase. And it does this every single cycle. It flushes people out before it really starts to make a move. I think this is probably going to go up, have another similar move like we saw early this year, or consolidate a little bit when it almost doubled from 63 to 103. And then I think we've got a lot more legs here as we work back towards highs. But this is a normal type of cycle. You bottom, you fake people out, and then you start the parabolic move. So we're excited about deals and drugs. The thesis hasn't changed. Where's the value? Not in the buying in the hole. It's in the waiting here that most people get thrown out, and everyone gets thrown out here. We just hang on because we don't run leverage. And then when you get these doubles and then another double, and then everyone gets excited a year and a half out from now, and you have a quadruple over 4 years, that's what you get paid for. And you don't get paid for running in and out in the headlines and all this nonsense. So aerospace and defense, this is starting to move. By the way, big sleeper that no one's been paying attention to, ladies and gentlemen. We flagged it a few weeks ago when we got aggressive in Boeing, and it got to the low 170s. It's now, with all the noise, quietly climbed up to $191 from the low 170s. I think it even touched, it got lower. It got down to 160 actually. So, what do we know? It always has to go a little against us before it turns. You got all the worst headlines, whistleblowers dying, planes falling out of the air. And I'm not making light of that. It's serious stuff. But at the end of the day, ladies and gentlemen, it's still a duopoly, and it's got a 10-year backlog with 5,600 planes. I mean, there's not a lot to think about here, guys. It's like, ladies and gentlemen, go ahead and try to not bring your kids to Disney. Social services will come take you away as an abusive parent for not bringing your kids to the parks. So, some of these businesses, they're one of a kind or two of a kind, and you got to take advantage when the market gods give it to you at 50 or 60% off. And that's just the way it goes. Small caps relative to S&P, these are going to rip, ladies and gentlemen. First cut, these are going to just rip, is my view. And you could just see these opportunities. Same with the REITs we've talked about. What is this? Transports. That's you got Boeing included. You have the FedExes of the world, the UPSs of the world. Everything people are down on. Oh, GXO Logistics, another mid-cap company, by the way, we're going to talk about. This falls right into this bucket. People couldn't be more depressed. They haven't been this depressed about logistics and transport since the pandemic lows in 2020. And if you'd bought those, you made bank, i.e., were you listening to this podcast? So, TLT, we're going to talk about that a little bit more. By the way, we've consistently said rates will go to below 4% before they go above 5% when they were at like 480 and change. And that's proven to be the case so far. Let's see the jobs data tomorrow, the inflation data next week. But everything is moving according to plan. That's why you're seeing the biotech start to get bid and everything else. Financials. Financials is bifurcated. If you look at the regionals, they still have a long way to go. If you look at some of the money centers, which we have Bank of America and Citi, I think they could take a breather, but we like them because the M&A cycle. So here are the regionals. It's just coming out of that base, has a long way to go. I think when you look at like Citi, and someone asked that, by the way, for one of the questions, it's had this huge move, almost double off the lows. We own that, and Bank of America. I think they could rest here, but there's nothing to do. Like, I'm not going to try to trade around it because this is a long-term play. We bought them really cheap. Let them wiggle around. I think the M&A cycle, the reason we own a basket on the KRE and the individuals on the money centers is because we believe the M&A and financing cycle is going to come back like nobody's business in the second half of the year. So, even if it rests for a little while, we'll be positioned to take advantage of it when they take off. Industrials have been underperforming a little bit. That's where you get your Generac, your Stanley Black & Deckers. We like that action. Tech has been outperforming. That's why we own Google and Amazon. And now we rebuilt Intel. If you remember, we bought at 25, sold in the high 40s on the basis of the legacy business last week. Came all the way back down to 30. We reloaded up that 2/3 that we sold at 48 to 50. And we like that story moving forward, and we referenced it on Cavuto. Utilities just coming out of the hole, which we had talked about along with REITs. Staples, same thing. There are some opportunities here. We like Hormel in this area, and we're looking at a few more, and discretionary. There's going to be a lot of opportunity here. People think the consumer is dead. We think there's opportunity being created. You even saw in some earnings this week. Let's see here. Retail, similar thing. I didn't see how Lulu closed because I know that's been a question on this call for a while. It got down to like 293. I think I wanted to see it get down to 250. It didn't do that, but I think it actually didn't close as strong as it opened. I don't know. I was running around today. So they kind of, oh, by the way, their China business was up 50%, FYI. So our China thesis is perfectly intact through Alibaba, and we're seeing it reflected. We benefited from that in our Canada Goose. The Goose is loose. We saw the numbers there. We also saw with VF Corp, their China numbers were big. They just got to get the US in place, and they brought that lady from Lulu to do that. Let me just pull this out here. Yeah, so it was up like 10% and it backed off. We'll see about Lulu. Nothing to really do there. That would be an error of omission versus commission. I know a lot of you like that. I kind of liked it. I just wanted to see if it could get lower, but there was no space for it anyway. 10-year yield, guys, 10-year note. This is just starting, ladies and gentlemen. As we've been saying since summer of last year, before the first rally started, is large traders and hedge funds haven't been this short since before the huge rally in 2019 in bonds, compression, and yields. No change in that thesis, guys. This is going to at least 120 in my view, which implies a 10-year yield between 350 and 375. From my lips to God's ears, I can hear it already. 375 is probably the spot, but let me just take a look at this actually. 375 might be a little aggressive, maybe 380, but leaving that aside, lower. Lower is the name of the game. And yeah, we'll see. But that's going to be good for a lot of things. Small caps, dividend payers, real estate, you name it. It's coming, ladies and gentlemen. Just hang tight. The money is made not in the buying and the selling down here. It's in the waiting here when you lose your conviction, even though nothing's changed in the thesis, ladies and gentlemen, and the impact of what this is going to have on the crown castles, on the Cooper standards, anything with a balance sheet like with debt, like VF Corp. These things are all going to rip as this rallies and rates come down and the refinancing window opens. Stanley Black & Decker, all of them. As soon as that happens, they're going to just rip, because right now everything with any debt has been selling off because of recency bias. People extrapolate what's happened in the recent past. Rates went straight up, is going to persist in perpetuity. And once everyone gets in that side of the boat, the boat flips over, and you want to be on the right side. Same thing here. Magnificent 7 earnings expected to decelerate, while the other 493 earnings expected to pick up. And we're positioned for that, certainly. Corporate buyback binge. You see that the corporate buybacks are the largest that they've been here in May. And going all the way back as far as the eye can see, the buybacks are in vogue again. Sentiment survey, we didn't get to put it in the article today, still about neutral, which is not what you see at tops, by the way, which is why I think this summer rally has some legs, as we discussed with Neil on his show. National Association of Active Investment Managers, yes, they are overweight equities at 95%, but you can go a lot higher for a lot longer. Here it got up to 102, and this rally kept going for another 6 months in 20 earlier in the year. And you see that over and over throughout history. Let's just go back a little bit in history. So up to 106 here in 2020, and it just kept going and going and going. I think we're just coming out of this death trap in 2022, and this is going to push higher for some time. GDP now for Q2 is 2.6%. So not as good as it was, better like a number of weeks ago, better than it was like a week ago. So that's that. I don't know what I just did to lose that post. Here we go. From Seth Golden. He says the top is not in. Historically, the market has never made a top for the year in the month of June. And here's the data going back all the way to 1980. And you can see that the market has never topped in June. This doesn't mean it couldn't be the first time. But again, we play the odds and here's the, burden ourselves with the facts. I love this from Jason Gopfert over at Sentiment Trader. He does a comparison of the 2009 lows in the S&P to the recent lows in the Hang Seng Index. So a 50% crash from a real estate bubble is what we had in 2008 to 2009. The S&P crashed 57%, and then it rebounded 45% off the lows. And then you got this huge check back in mid 2009 before the continuation where it went up a lot more than that, and then a lot more than a lot more, and was the beginning of many multi-year bull market. We'll take a look what happened. We had this big 52% down on the Hang Seng because of real estate. Then we had this big 31% rally, and we just had the check back, just like we did in summer of 2009. So real estate crash, huge rally off the lows, check back before the monster parabolic move, 52% crash off of real estate, big rally in a short period of time, big check back, and then we're going to get the parabolic move, ladies and gentlemen. We've talked about this over and over, and we're excited, more excited than ever. But again, nothing's ever changed. Like, you think that the thesis has to change week to week based on headlines. The big money is not in the buying and selling, but in the waiting, ladies and gentlemen. And it's definitely genetic. So, all right. Moving along, some other charts here. Non-farm payroll. This is the weakening that the Fed needs to see, and hopefully will be confirmed tomorrow in order to move with their first cut, which now should be in September, maybe sooner, but definitely I think September at this point. They may try to do it over the summer if the inflation numbers are weak enough next week. In Europe, the PPI was negative this week. And if the jobs number gives them cover tomorrow, maybe in the summer, but more likely September. The only reason I think they'd want to push it to the summer, though, is to be well ahead of the election. ISM Services PMI continuing to go in the right direction. Market pricing for cuts went back up to 2 this week. It got down to almost 1 in late May. This is equal weight to cap weight PEs on the S&P. The equal weight is at 16 and change. The cap weighted is at 20 and change. So that tells you about all the opportunity under the surface. Tech sector alone comprises 31% of the S&P versus 6% in 1990. Sector driving overall market valuations higher as it tends to trade as a premium. Top 10 weights as a percentage of overall index is now 34.1 versus at the tech rec peak was at 27. I'm not calling for any type of peak. The economy certainly changed, but I do think that there's going to be an abrupt rotation where these are going to do a lot less well, and the ones that have been left behind are going to start to pick up the slack and really drive the bus. It won't be just the AI plays. It'll be the AI beneficiaries, which are going to be a lot of industrials, a lot of transport. You heard the GXO call. All the things that they're implementing across their business are mind-boggling. And then their humanoid robots. It's just bananas. Job openings, JOLTS came down bigly this week. And here's another third quote of the week. Why don't we have 10 quotes of the week? Well, here we go. Peter Lynch, know what you own and know why you own it. The reason people get shaken out in the short term is either greed, impatience, or ignorance, meaning they have no idea why they own something and therefore they should not own it. Would you buy a business in town if you didn't do your due diligence and understand the free cash flow, the expenses? I mean, just basic stuff you could do on a napkin. How much does it cost me to run? How much revenue does it bring in? What's my profit? Why people don't do this when they buy shares of a public company, when all the information is free, transparent, and audited, is beyond me, but that creates the advantage for us. PayPal starting to show some signs of strength again. Fastlane's a big deal. This is from Andrew Chris. So just as a quick reminder of what Fastlane is, this is really targeting the guest checkout experience, 70% of checkout, 60% of checkout. Because of the breadth that we have in our customer base, we're able to create an uplift for customers that are returning customers. We cover this. So 80% conversion ratio versus 40, 45, 50 for a regular guest checkout experience. This is a massive win for merchants. I think people are starting to figure that out. Then you add the ad business to it, and you got a monster business. So towers and trucks, stock market and sentiment results. We're going to talk about Brad Jacobs' company, GXO Logistics. As a reminder, number one, you can click here for our original note about GXO. Cyclicals are ready for their turn at their plate. The Fed will be the catalyst. This shows market breathtakingly bad, where since 2009, this is going to inflect just like we saw in 2020 and we discussed just a few minutes ago. The key is the Fed is going to be the catalyst. Okay, now just an aside, if you'd put $1 million with Brad Jacobs when he got involved in URI at the IPO, you made 50 times your money. I think it was 57. And then when he got involved with XBO in 2011, you would have made about 52 times your money. So GXO is spun, same DNA, great business. We get 2 bites of the apple because it's going to also benefit from the UK recovery and the dollar weakening and the pound appreciation as they get a good chunk of their business from the UK and from Europe. We're very, very excited about it. And hopefully their management won't overly hedge their book, which I should probably call into investor relations and just throw in my 2 cents about that. But the key is, does the business generate cash and is it growing? And the answers are yes and yes. The most important section of this release is the 2027 targets, which imply the business will nearly double adjusted EBITDA by 2027. The implication is not only a potential doubling of the stock, but with double-digit top-line and bottom-line CAGRs, compound annual growth rates, we can expect to see a re-rating from trough multiples to more normalized multiples consistent with a double-digit grower, i.e. a cash machine, baby. As a point of comparison, its parent XBO Logistics, another Brad Jacobs company, has an average historic PE multiple of 25 times. URI had a similar situation. We also think guidance may be very conservative as all of Jacobs' companies have tendencies to find new accretive acquisitions that are not yet baked into guidance. This is key. This is what they do. This is their knitting. No one does it better. A lot of managements do stupid, dilutive acquisitions to keep their jobs so they have 2 more years to integrate it. Not the Jacobs family. They do smart deals and they respect owners' capital like no one else. They are the people I want skin in the game with. And that's that'll never change. As a matter of fact, I want to start to take a look at his new housing supply roll-up. And we'll probably have more to come on that as we understand the business. All right, so they grew revenue 6% year on year. 1% was organic growth. That's a big deal because what happened during COVID, everyone spent money on goods. They benefit from goods. Why? They do warehousing. They do logistics. They do reverse logistics, meaning they handle refunds for e-commerce sites, et cetera, et cetera. So they finally troughed in organic revenue, are starting to re-accelerate it back towards their double-digit target. And the inorganic from smart deals was up, enabled them to be up overall 6% with $2.5 billion of revenue for the quarter. New business wins of $250 million in annualized revenue, up 55% year over year. Sales pipeline at a 12-month high of $2.2 billion. We're going to get into why that is, but more and more companies that need to increase their margins need to outsource their logistics business to GXO, and they're basically the only game in town. Literally, it's them and DHL. So if you want to talk about being smart about there's only one Disney, there's only one Boeing, i.e. two Boeings, Airbus and Boeing, you want to be in these oligopoly or duopolistic markets that have scale, and GXO is a sleeper that no one's paying attention to, that you can't give away at 50. Everyone will be interested at 100. People will be clamoring for it at 150 and beyond. I think this thing can really be something over the next 3 years. Our conservative, we get into businesses that we think can double over 3 years, okay? And we obviously, not all of them are going to work, but most of them are, and we try to be conservative so that enough of them are 3, 4, or 5 baggers over the same period and have the legs to deliver on that. I think GXO is one of those that's going to really surprise us in terms of the multiple it can deliver and the management execution and the timing and the price at which we're getting involved. So I'm excited about this one. So they are gaining market share. That's a key thing. They completed the big acquisition of Wincanton, which we're going to talk about. 1.8 billion top line, 1.1 will be realized in the first 12 months. Well, I'm cuffing that number from what I remember last night at 2 a.m. before I got the call at 6 a.m. to go into Cavuto. Been a long day, but let's move ahead. So we are seeing strengthening demand from global blue chip customers to realize operational efficiencies today while planning fulfillment strategies to meet their future needs. By the way, I think they have 25% of the Fortune 100 companies now as customers. You can go back to the original note and look at the quality of the customers that they have. It's, all right, I'll do it. I know you guys won't do it. Here we go. Where is it here? Some of you will, though. All right, so they've got Nike, they've got Mars, they've got Heineken, they've got LVMH, they got Red Bull, they've got Unilever, PepsiCo, you name it, and it's just the beginning. So, looking forward, our growth trajectory is accelerating. We're investing in our sales organization, expanding automation and AI across our footprint. So this is an AI beneficiary. This is the next phase of the AI trade. And diversifying in new geographies and verticals to best position ourselves to deliver shareholder value through profitable growth. We expect to deliver double-digit accretion to adjusted EPS post synergies. That's as it relates to Wincanton, which also gives them a platform for growth in attractive verticals, including industrial and aerospace in Europe, which they had not had. Now they've got some Boeing business, so that's all moving in the right direction. They generated $50 million of free cash flow from operations compared to $39 million for the first quarter of last year. $423 million in cash, $1.6 billion in debt, investment grade balance sheet. So that's healthy. And then they've got their guidance for this year, 2 to 5% organic revenue growth. So they really did trough last quarter when they said they did, as many of the companies in our portfolio. Rather Q4 was the inflection for a lot of companies, some in Q3, but most in Q4 of 2023, including the impact. So they expect to earn about 273 to 293 of fully diluted EPS, which implies they're at 10, 13-ish, 14-ish multiple right now. This company, as that re-accelerates, they should get up to a 2025 once they hit double-digit growth again over the next 12 to 24 months. And the synergies start to flow, and UK picks up and all the different things and the currency and everything else kicks in. So this is good. And then if you look at their 2027 targets, where their EBITDA is going to go up to 1.3 billion on the top end, nearly doubling their business. That's a big deal. That's a relatively short period of time. We're halfway through 2024, ladies and gentlemen. So two and a half years out, market will start to discount that 6 to 12 months beforehand. $6 of earnings at, instead of a 13 times multiple, maybe a 20 times multiple. Do the math. Do you need me to do that again? $6 of earnings at, maybe a 20 times multiple, 25 times multiple. Come on, ladies and gentlemen. Look, even if we're too optimistic, it's still a very healthy and attractive IRR. Operating return on invested capital more than 30%. Look, I understand why they do operating return on invested capital. I'd like to see them do return on total capital, the amount of capital that I have given them, meaning the collective owners have given them to invest, and the return on that, which is lower. But I definitely understand why they break that out, and it's a sensible thing in their business. And I'm very comfortable with their ability to consistently compound at 30% operating return on invested capital. So, but URI did that too for a while. It was URI or XBO, but they had high single digit return on total capital, but their return on operating capital was much higher. And that's why the stocks compounded so quickly. So it's not a bad thing. It's a good thing, not a bad thing. Revenues are up. That's good. Their earnings got hurt a little bit by this one-time legacy litigation expense of $63 million. It's what lawyers do. You got to live with that. They paid down debt a little bit here. I noticed operating cash flow is up bigly, so that's good. Their cash is about the same. And you can see the breakdown by country. UK is almost half the business. Not quite, but about 40% of the business. So as we get weaker dollar, stronger pound, and they don't overhedge, that's going to be a good thing. And then you've got US's a little 7 times, about 33, 34. And then you've got the rest of Europe. So Europe is a big part of their business. I like that story right now. Germany seems to be actually doing well. They got a big client from Levi's. We're going to talk about that in Germany. It's humming. And this industrial manufacturing, which was such a small part, remember the biggest part of their business, about 40%, was omni-channel retail, like e-commerce and electronics. Now they've got this vertical to really start to hum in industrial and manufacturing, which I think is undertapped. And that's a result of the newest acquisition that they completed, which is a big, big business. So, all right. Operating return on invested capital, 32.7%. And some highlights. We talked about the sales pipeline, 676 million of new fiscal year 2024 revenue, 1 through Q1 2024, equivalent to 7% year-on-year revenue growth. That's a big deal. 26 million year-on-year increase in free cash flow for 1Q. Operating return on capital was good. That's what they said they're going to do, 30. They did 33. Completed the acquisition, and they placed 1.1 billion of new 5 and 10-year bonds in Q2. So that's good. Here's their 2027 targets. So they did 2.5 billion of revenue this quarter. They're going to do 16 billion, up to 16 billion annualized in 2027. That excludes any new acquisitions. And these guys, I know they said their job is going to be to digest and synergize the new acquisition, but they just can't help themselves. They just have this uncanny knack to find accretive, really smart, amazing deals. This number is going to be too low, in my view. And then that's a revenue CAGR of 10%, EBITDA CAGR of 15%, EPS CAGR of 15%, operating return on invested capital they'll keep above 30%. So all good stuff. Okay, sequential improvement. So they're gaining market share. We signed approximately 250 new business, up 55%, including new contracts with Boeing, Guess, Michelin, Puma, and WH Smith. Half of these new contracts came from customers outsourcing to us or partnering with us for the very first time. Here's the other thing they point out, which I emphasized. When we last spoke, we said the fourth quarter was the bottom for organic growth, and that's reflected in the sequential improvement in the first quarter, as well as the sales and pipeline activity we are seeing. Okay, so lifetime value. Okay, they also announced a landmark new 20-year partnership with Levi's in Germany, where we're building our presence with the acquisition of Clipper. This will be highly automated, newly outsourced operation with a lifetime value of $1 billion. That's just from one client. This is one example of the trend we're seeing where customers are looking for longer-term partnerships to address their fulfillment needs. So they're giving them all their outsourcing and they're giving them to them for a long time so they become embedded partners. These are not customers. There's no churn on customers once they get them. They got them and they improve the earnings power of their clients. They do it at scale. They do it efficiently. They do it with robotics. They do it with AI, and they do it with little competition of their scale. Okay. So larger deal sizes and longer contract lengths is the theme, as well as gaining share. Now, they talk about Wincanton. It expands the GXO's presence in strategic growth verticals in the UK, including aerospace and industrials, providing GXO with a springboard to offer these services across Europe, and it will be accretive to earnings per share in 2024. Immediately accretive. That's unbelievable. Double-digit accretive, including full run rate cost synergies. These guys have a formula. When they say double digit, they mean double digit. That's what they deliver. That's why I have skin in the game with them, and we're co-investors with them. Take market share. Okay. AI-driven automation is a key tenet of our value proposition, and we're a first mover in training in the integration of cutting-edge automation like humanoids and AI inside the four walls of our warehouse. Innovation in AI, we've had a productivity increase of approximately 15% from their AI implementations. Our tools make more than 15 million decisions per minute to streamline inventory replenishment. Who can compete with that? If you're a retailer selling shirts and shoes, you're not focused on logistics where you can make 15 million decisions per minute. You're focused on designing shoes that people want to buy, which makes them indispensable, which is a good place to be, and oligopolistic, which is a great place to be because you don't have much competition at that scale. Continued acceleration in organic revenue growth throughout 2024 and beyond. They talk about the pace of outsourcing in this $450 billion total addressable market. GXO is set to take significant market share over the long term. Look, 2017 target is 16 billion. It wouldn't shock me if they do 18 or 20, but that's still, 5% of the business. His historic thing is, if I remember from his book, is to take 15% of the share of the businesses that he enters. So if he takes 15 of 450, $60-ish billion business, give or take, being conservatively, 60 of that at those type of margins. I mean, that would be staggering. But even at 45 billion, you're looking at a four-bagger from here and multiple. Anyway, let's not get ahead of ourselves. Let's just focus on a double over a reasonable amount of time, and let these amazing executors deliver. Pipeline is here. Our customers are making faster decisions to outsource their supply chains, reflecting returning confidence in their long-term outlook. As a consequence, sales cycles are shortening, and our pipeline is delivering results faster, with deals getting larger and contracts getting longer. So more than half of our wins in the first quarter were with customers outsourcing or turning to GXO to support them for the very first time. We serve more than a quarter of the Fortune 100 companies, and the success of our land and expand strategy is evident in that half of our revenues come from our customers we partner with in more than one country. So if they get Levi's in Germany, which they just got, you can be assured in a year or two, they're probably going to have Levi's all over the world. New warehouse in Maryland. Okay. So this Friday, they're cutting a ribbon at warehouse in largest building in the state of Maryland. We're supporting personal care and appliance manufacturing Conair in this 2.1 million square foot facility. The solution consolidates 3 sites into a single automated operation that handles all of Conair's brands across retail and direct to consumer, enabling their growth and combining fulfillment with high value add services like product testing. We also recently expanded our 13-year partnership with global apparel company Guess, originally in Europe, across the ocean to the US, turning it into a global partnership. So they got them in Europe, and then they got the US later. Guess had previously run their North American operations in-house, and they've entrusted us to help them unlock value in their supply chain by outsourcing. We now operate 3 sites for Guess in Italy, Netherlands, and now the US. Landmark Levi's win in Germany. Levi's Super Hub, allowing Levi's to supercharge their omni-channel growth strategy, drive a competitive advantage through their supply chain. Okay, this is why I'm confident we'll deliver strong growth and new sales wins in 2024 and beyond, taking share of our enormous addressable market. To remind you, $450 billion. Very exciting. All right, so now the CFO is talking about 6% growth. The one-off legacy, operating return on invested capital, 33%, surpassed all expectations on free cash flow in 2023. Balance sheet rock solid. They have an investment-grade credit rating, no debt coming due in 2024, attractive valuation, accretive deal, and they talking about the accretive deal gives us exciting exposure to the industrial and aerospace sectors in Europe with well-positioned customers like BAE Systems, EDF, and Alstom. This is going to be a huge business, ladies and gentlemen, through their Wincanton deal. Even before the $45 million of cost synergies, we now expect double-digit adjusted EBITDA growth at the midpoint of our guidance rates for this year, which is $805 to $835 million. We've reiterated organic growth of 2 to 5%. Acceleration in organic growth, free cash flow conversion, revise the targets, margin expansion, clear path to achieving compounding double-digit top-line growth with 15% adjusted EBITDA CAGR, even faster growth in adjusted diluted earnings per share. GXO's growth is accelerating, and we are delivering operating return on invested capital and free cash flow conversion ahead of our long-term targets. We've just completed a great acquisition and an attractive valuation, and we'll continue to allocate capital in the best interest of our shareholders. Look, if you can give money to a management group that can compound it at 30%, you want to do that all day long. And that's why we did. Malcolm Wilson, CEO, back to him, positive trend. Okay, consumer volumes are now stable. So the problem that we saw after the 2021 peak with consumer volumes are now stabilizing and reaccelerating, which is what? Destock to restock, which we covered at the beginning of the podcast. This stuff all meshes together, ladies and gentlemen. When you can see the pieces and the patterns, that's when the magic starts to happen. And it's all playing out, as we've been saying for the past weeks and months, for those of you who've been with us. So, sales pipeline's up, business wins are up, consumer decision-making process is speeding up. All right. So the analysts ask about this 20-year contract. Is this a new trend? Because this kind of didn't happen in the past. Super proud of Levi's. It underpins our progression into Germany that we set out to do last year following the acquisition of Clipper. That gave us a strong foundation. It's Europe's largest economy, and we absolutely should be there with our automation, our know-how, our agility, laser focus in the warehouse. And I think if you recall last year, we opened up a speculative warehouse, which we don't normally do in Germany because the opportunity is so big. And I'm pleased to announce that that warehouse is now full, including aerospace wins that have come to us in this region. Pivoting to Levi's, so it's great iconic brand. We entered in a consultative process and a deep partnership. That's what reflects the 20 years. This is a high investment, Germany's greenest warehouse. Iconic brand, 170-year-old. When you think about the sorts of partnerships, that's normal. Full product. Okay. TAM, covered that. ROIC. All right, then going back to Winketon. So industrials, it's not our strength area in the UK. This is going to make it our strength area. Aerospace, as Barish mentioned, some really big blue chip customers, public sector spending, and these are all things we can convert not just in the UK, but across our continental Europe-wide business. So it's very, very good from that perspective. It's accretive pretty much from the get-go, 45 million in cost savings. As I mentioned earlier, our UK business seems to be the market where we're seeing the earliest real recovery of consumer goods spending. So it's great news that we're doing this deal right now. I think the timing of it is very, very good. By the way, this may translate over to ASOS. Maybe we're going to start to do some more work and potentially get a little more aggressive there. That's been a tiny position that we've just been sitting with. But and that's why you do the work and you listen to these calls and you dig deep and you do channel checks, because what we learn about Canada Goose luxury jacket sales in China impacts what we know for our position in Baba. What we now know about the UK business in GXO affects our thinking in things like ASOS and other opportunities in the UK. So sizable business. Okay, so Winketon, okay, P&L, 45 million, we got that. This new vertical, Springboard in Germany. Strategy coming to life, all right. So Winketon's got a top line of $1.8 billion, of which 1.1 billion is it going to be this year, and then roughly 700, and then 700 million more next year. In terms of the overall competitive environment, the industry is consolidating. These are the consolidators, not the consolidatees. This is a good thing. I mean, Winketon, I guess, is a good example of that. And you now see it in all the major territories. Larger companies are getting larger. And that's reflecting what customers are doing in one regard. Customers want to be supported by well-organized, strong, financially organized companies. These large automated solutions. That's why the investment grade is so key. That Richard has mentioned, it's really not easy for smaller companies to deploy those kind of solutions. So the very nature of our market, more and more automation, AI, is really revolutionary in what we do now in the warehouse alongside automation. All of these things, it's really best accomplished by large scale businesses. And that's why we see such a strong demand for our services. That's why you see this kind of double-digit new business type of numbers we mentioned. And you're seeing traditionally over the period that we've been talking, overall, the competitive environment is what it is. No large-scale companies like ourselves. There's a tiny number of them, i.e. DHL. That's it. And I think they're all set to do well from this consolidating market, and the fact that solutions are becoming more and more complex favors companies like GXO, i.e. we are a duopoly to oligopoly, and our position strength is going to get better and better and better. We're going to just roll up all of these businesses at really great deals because it's a fragmented industry, and they can get them at good multiples. So first-time outsourcing is a secular, not cyclical, secular tailwind. Malcolm just said the challenges are more complex. If you look at continued, our customers need us to help them save money. Automation really is the only way you can deliver a competitive advantage of that, and you need to provide it. Like GXO has got a vast catalog of resources to deploy those quickly in an integrated way. Okay, growth, consumer goods starting to recover. Investing to capture a greater share of a strengthening market. Blah, blah, blah. So we got that. Now, that's trucks and warehouses. Now we're going to do towers. Crown Castle is a cell phone tower provider that generates cash to pay out to owners. Because it is a REIT, it trades on yield. It will trade up in price as rates come down. This position is core to our thesis that dividend yield is cheap and will be in high demand in short order as the first Fed cut is in sight. Here you can see that dividend yield is relatively inexpensive versus history. It hasn't been this cheap since 2002 when small caps and dividend yielders and emerging markets all rip-roared for the next 4 to 5 years. And you see the names that we're talking about reflecting these several major themes. Crown Castle currently has a 6.04% dividend yield. Here's why some of the catalysts. Starting with the new CEO, Stephen Moskowitz came from American Tower, which was the biggest cell provider in the country. It was most profitable under his stewardship, et cetera, et cetera. So now, basically, they got a new CEO who crushed it at American Tower, by the way, and he's going to be involved in this strategic review of the fiber cell, which has been the weight on Crown Castle stock. They're probably going to sell it off and just keep the legacy profitable cash machine towers and add to those. And so they'll delever the balance sheet, they'll lower their interest expense, and then they'll add the most profitable legacy assets on a pro forma basis, where he is a master of that. So they delivered organic growth. So I'm less really concerned about the rear view mirror as I am. They've got $6 billion of liquidity under their revolving credit facility. Strong operating. Okay. A 25-year industry veteran, Stephen is. Notice the theme, by the way, of we like to bet on jockeys. Okay. So in Advanced Auto Parts, we got the guy who ran HD Supply, $7 billion business for Home Depot. In VF Corp, we got involved because of Bracken Darrell, who came from creating a 27-bagger in Logitech. So that's a theme across a lot of our holdings, is the new jockey. And that's what we've got in Stephen Moskowitz. During his tenure at American Tower, their U.S. operations became the largest and most profitable U.S. wireless infrastructure company, tripling in size to more than 20,000 cell sites. So he knows where all the opportunities are. He knows where all the dead bodies are. This guy can execute, and he's going to be an enormous asset for us. Oh, and by the way, we're going to get the tailwind from Powell. Rates are going to go down. These businesses are going to go up. And then you got a guy on top of it who can actually execute. It's a win. All right, moving along here. Significant upside, best in class in the industry, optimistic about the future, us too. Update on Cooper Standard. No news is good news. The only thing that we saw here was U.S. auto sales came in very, very strong in May. Big jump over May of 2023. So we like that trend. We're seeing more incentives, which was part of our original thesis. And we think everything is in place there. Although as the Fed cuts, you're going to see these type of stocks just rip higher, because it takes the perceived balance sheet risk for companies like VF Corp, Cooper Standard, Stanley Black & Decker, CCI off the table, and then they just start galloping, and everyone's like, what happened? Well, they were great businesses and they were fine even if rates didn't come down, but now that they're down, like, just the money's going to flow. You'll see what happens. This is neutral. CNN, fear and greed. We already covered the NAIM. Moving along, we've got Dow earnings, top 30 weights in the last 60 days. Estimates were revised up 1.34% for this year, up 0.02% for next year. NASDAQ, similar story, up 1.8% for this year, 1.5% for next year. So that all looks good. We covered Bloomberg Radio. We covered that. Don't know why those are back up. All right. Earnings continue to go up. So now we're back up to 245, basically 244.68, 278.87, which is what we covered last week. People are saying 20.5 times forward is too expensive. I say, compared to what? We compounded from 2000 to 2024 at about 6 and change. Earnings growth. Now we're growing at 11 this year, 14 next year. If you think in terms of PEG, you could have a little bit more multiple expansion before we get crazy frothy, and we saw that in a lot of the indicators we look at, kind of in the middle range, not at the extended range, which is why we think a summer rally could be continuing and happening aggressively in coming weeks. All right. The economic data, I'll just show you guys, the PPIs were negative big time in Europe this week, so they cut. The jolts came in a lot higher than expected, so that's what the Fed needs to see. ADP came in, the new jobs lower than expected, what the Fed needs to see, and tomorrow will be a key number for sure. Okay, now let's go on. Okay, so the podcast is over. Anyone that wants to stick around for the Ask Me Anything questions from our listeners, please stay. We will play the disclaimer at the end of that. So Matt Mitchell, hope summer's starting off well for you and the family. Not sure if you've already covered this week. Could you please give us your updated thoughts on Citi? While valuation, price to book, price to tangible book has recovered from the back half of last year, still it doesn't seem like it's reached fair or excessive levels, especially if M&A markets start to thaw in second half 2024. Matt, 100%. You've been listening closely. Yeah, we think it could stall, but then it will resume. It's just got to digest the big gains that it's had already, and then and it'll take another leg higher into the reopening or acceleration of capital markets. Mike Digitano, thanks for the great, hi Tom, great, thanks for the great contact every week. You're welcome. Thank you for tuning in every week. I appreciate that and the support of all of you. Quick question regarding the Alibaba spinoffs. Do you think they're still going to do it? Answer, no, not really. I mean, they basically announced that as a way to say our sum of the parts is greater than the whole. This stock is too cheap. We're buying back as much as we can, getting cash out to do it. But then they realized they had a weak IPO market. So maybe you'll see the Freshippos get IPO'd after the Hang Seng doubles, and the Kainows and the like. But the core business, the Taobao, Tmall, Cloud, that's their core business. I think that's going to stay. Will they spin the international? I don't know. But I think that once the stock goes up quite a bit, I don't think that's going to be a core thing. They were just kind of pounding their head against the wall as to how to extract the value. And I think the way you extract the value is you execute and you wait. And now the waiting is starting to pay off. And I think we are in the first half of the first inning for that. Because I couldn't really see anything in the conference calls. No, they've already said they're not doing that. So go back to the last 3 conference calls. I'm asking because when they announced the spinoff, the stock went from 70 to 120 in 3 weeks. I'm wondering if they need a catalyst to move higher from here. Mr. Market's pendulum going to swing away from the pessimistic side by itself. Yeah, it's going to, opinion follows trend. Price will solve sentiment, not the other way around. So as you continue to see earnings results like this, where you see the Gooses of the world and the Lululemons of the world continue to show you that the consumer is coming back, and we start to see it on the ground, price will go up, multiples will expand, money will flow, and then Japan is restrictive, all that hot money. You saw the election in India. Their index was down 7% in a day. That's where all the Chinese hot money has been going, to India and to Japan. That trend is going to reverse. Out of India, out of Japan, back into China. Opinion follows trend. Lowest price is what you pay, value is what you get. You get the most value for the least price and the most potential upside in our view. But we have to do it carefully with high quality businesses, because the mid to lower quality business, you don't know what you're getting over there. So moving along, we've got Nolan Fernandez. By the way, the few of you have reached out about coming in at the smaller account size, and I haven't gotten back to you yet. I will get back to you, but we're not, and get you whatever the paperwork and have a chat. But we are not opening until Q3 for the smaller accounts. Nolan Fernandez, I was looking at your older articles on Cooper Standard. Do you feel like they're still on track to do over $3 billion in revenue and $6 to $8 EPS, or do you feel based on recent earnings that it's a bit too aggressive of a target? Yeah, they're going to do it. It's just a question of industry volumes and when. There's no question that's going to come back. Whether it's 2025 or 2026 is immaterial. The key is, as the industry volumes come, they've got the operating leverage. Nothing's changed with the thesis. We can't control industry volumes, nor can the company, but they can position themselves to have that inflection as the volumes come. And we're going to continue to see that. And I think we're going to see it much quicker than anyone expects. Vinay Desai, especially if rates come down, by the way, and people are going to start racing for cars, because on average, the average car on the road is over 13 years. And as rates come down, people are going to feel like the good old days, and they're going to rip roar as also dealers and OEMs start to offer real incentives to take down inventories. The game is going to be on. Vinay Desai, price is what you pay, value is what you get. Just because a stock has run up 50 to 100% does not mean it's expensive necessarily. We agree. In the case of Dell, which has posted high growth in free cash flow and has now dropped 30% peak to trough, is it something you would look to dive deeper into as to why the stock is up huge in the past year or so? No, I wouldn't care why it's up. I'd care where it's going. Look, you never want to get a bet against Michael Dell. I'd rather play this through Intel from $30. And this thing looks like it's peaking out, by the way. It looks like it priced a lot of stuff ahead of time. A lot of pull forward in terms of Dell. But yeah, I'd love to see Dell down 50%. I'd probably be a buyer, but it's not there yet. And to your point, the price has far outpaced the increase in free cash flow. And if anything, the free cash flow and revenues are rolling over as the price has gone to an all-time new high. So not for us. In this case, overprice is what you pay, undervalue is what you get. In the short term, in the long term, this guy is going to mint money, and I want to participate, but I want to participate at the price that you pay, which is not at this level. Ridwan Muzaki, I wonder if you have any thoughts on Wuxi Biologics. Stock prices declined more than 80% on fears that U.S. bill will pass. Chinese biotech company. Literally the last thing in the world I would ever buy is a Chinese biotech company. And I've covered that multiple times. So I'm assuming you're a new listener. Very grateful for that. And we will not buy anything in China other than the biggest of the big proven names, because you just have greater. I'm not taking country and company risk. I need a sure thing company that's trading at a very attractive price. My guess is when I pull this up, all the numbers are going to look great. Yeah, like they always do, except I don't know if the numbers are true. So for that, I'm going to pass. On to the next. Matt Del Priori, looking to start a position in either Alibaba or Shopify for my personal Roth, which I've been trying to build for tax purposes. Since I'm a long-term investor, 27 years old, is it better to lean towards these kind of companies in my Roth because of my time horizon, or my company's 401k and my company, because of my time horizon and my company's 401k is mainly index funds? Look, you want to maximize your Roth every year. Generally, if you're going to hold the company for a long time, you don't pay taxes until you sell, except on dividends. So it effectively acts like an IRA until you sell it. And that could be 20 years from now, depending on the company you own. But if you do intend to sell, certainly inside a year, anything you're planning to do in less than a year should be inside an IRA so you don't pay the ordinary income tax. Again, this is opinion, not advice. Talk to your financial advisor and CPA. But if you haven't maxed out your Roth, you want to do that first. Do any trading type stuff you're going to do inside the IRAs. But once those are maxed, your long-term holdings, you don't pay taxes until you sell. So it's a beautiful thing of the tax code. Hopefully they don't F it up. Kareem Devadaga, I'm looking to pick up Akamai in the 80s. Could you tell me your thoughts on this one? Looking to make $6 a share, loaded with cash, big buybacks, thinking a good value play. I think I have looked at this one and did nothing. You know, these video game companies are great when they're great, and then all of a sudden they just hit a brick wall because it's like the hits business, like movies used to be. So I don't know. Their margins continue to contract. I think for me, I don't know why I came to a no on this, but I did, or a pass. So it's down from 130 to 90, and let's see, accept all. Let's take a look at the financials here. All right, so the revenues are growing. The share count is declining. That's good. The earnings per share have been flat since 2021. Well, declining, now starting to recover. Free cash flow looks okay. It's been basically flat since 2018. What about operating cash flow is improving? That's good. Gross margins are declining a bit, but seem generally okay. I'd like to see this come down a bit more. I'd probably take a look at this again at 75 if it takes off without me, or of omission versus commission, and then I really need to understand the business and their hit pipeline and all the things that go into that. But generally, you should be okay. I just like to pay lower. Hope all is well. You've had an awesome week. This is from Frank Brown. Roku. Feel like there's a good opportunity. All right, let's take a look at Roku. I haven't looked at this one, I don't think, in a while. All right, so it's down from 490 down to 55. I think this is one of the ones that a very popular figurehead was saying was going to like 4,000 during COVID. Let's see here. Sold to you, I guess. All right. So yeah, it looks like it's recelerating on cash flow, on revenues, EBITDA margin. Gross margins are declining. Revenues keep growing. Share count stabilized after it took a big jump in 2021. Cash from operations is starting to move. Free cash flow is recovered from the 2022 lows. They are not compounding capital, so I got to understand this business better. Their margins seem okay. What does their balance sheet look like? Maybe that's the issue. $2 billion in cash. Zero long-term debt, is that? Okay, they got $1 billion current liabilities. Let's see. What is that comprised of? No, that's not debt. Long-term leases, long-term debt. Balance sheet looks pretty clean. So I probably have to go to the source documents. There might be something here. I mean, when you think about it, we all have like 10 Roku TVs each. I mean, everyone has these things. I guess, can their moat be impaired, or is it going to just platform and devices? I think this one's worth exploring. My guess is it goes lower before it goes higher, but this level, I think you got to take a deep look. So that starts with the conference calls, it starts with the public filings, it starts with the competition. It really starts with understanding the business, predicting what the business is going to look like 3 years from now. Just ask all the streamers. None of them have any damn clue whatsoever. And for me to think I'd have an edge on that is a little bit presumptive. However, if the margin of safety is high enough, I'm willing to accept some level of risk that I don't know what I don't know about the future. What I don't like about this is I kind of have to do some predicting of the future, although maybe it's baked in at this time and there's some inertia behind it. But I think you got a decent find here, Frank, and it's worth digging a lot deeper. And I'll leave it at that. So with that said, we'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.